for the summit for inviting us here today. Yes, we've discussed with Keith. We've been working with Keith for the last 3-4 years. He's been a great supporter of us, and we're certainly thankful for that. My name, Brian Schmidt. I'm a little bit about my background. I used to run Apache Canada, and then decided to go into the small junior sector. A lot of us, including Ken Cruikshank, my VP Land, is here today. We put in $2.5 million of our own money, friends and family money, and that's how we got started. We're a little over $500 million right now, so it's been a pretty good run for us. And one of the things I hope you get today is how disciplined we are about rates of return, about payback periods, and what that does for corporate performance. So a little bit about the forward-looking information. I guess these are all estimates I'm telling you about today, so you take it as such. Just context. We just acquired some oil properties, another low-cost, high oil-weighted acquisition in the Penny area near Lethbridge, Alberta, and it's already exceeding internal production and cash flow expectations. We just closed that deal in July, and I got some really exciting results I'm going to tell you about today. Now's the time in the down cycle. You're all aware of cycles, and I've heard speakers in this. This is a great time to get in the oil business. The stock performance since January has been very good. If you put your money in disciplined companies coming out of this down cycle, it can be very profitable, and I'm going to show you how we're well positioning this company. Now is the time to bring in inventory. So there's things on the market that I have not seen in 20 to 25 years. People would just not sell those kinds of assets, and they're being pressured to now because of bank. And so if you're well capitalized in this position, you're going to pick up superior assets, and when the market turns, you're going to be a real performer. We're going to take use our strong balance sheet in 2017 to take advantage of some of those tuck-ins, and we're going to ramp up the production when the commodity prices start to improve. We've got a great position. We're actually cut our capital on our drilling program down 27%. We've cut 18% out of our operating costs. We've cut 44% out of our G&A costs. And in a low commodity environment, this is all about cost structure. Profile on the TSX, not going to go through all these numbers. I'm going to tell you that the growth this year, we're going to exit this year at 11,000 barrels a day plus. And I think by the time I get through this presentation, you're going to get a pretty good feeling that I'm going to attain that 11,000 BOEs a day. We're about 50-50 gas liquids weighting. And you can see there was a previous speaker here who talked about the importance of balance sheet. We have $120 million on our line, and we've only drawn $58 million. So very strong company, debt to cash flow less than 1 times. These are our operating areas in Alberta. The Cardium oil, that's the workhorse for us. I'm going to focus on that today. The 2 most recent acquisitions we did are adding to our position in Viking, Redwater, and then down near Lethbridge in the Penny Barons pool. Production last quarter was 95.36. I'm telling you the exit's going to be 11,000, so that's very good growth. And you can see we acquired 1,900 BOEs a day on a deal that closed in July. This is our core asset, the Wilson Creek Alder Flats. Just below that little green battery on the lower left, or lower right, we drilled 2 wells back 3 years ago. The payback on those wells was 4 months. We only had 10 sections of land in that area. And you can see now there's over 310 gross sections, 229 net sections of land in that area. We just completed our first pair of 2-mile wells. If you can think about it, you're spending all that money to get surface lease, drill all the way down to your target zone, turning it sideways. 1 mile used to be the limit, then 1.5 miles, now 2 miles. And I'm going to show you on a cost slide that's really driven down our costs. On this slide, I'm just showing you acquisition criteria, and I'm also showing you what the 2 assets we just acquired in June, how they performed against that. We paid about $44,750 per flowing barrel for these assets. That's 75% light oil. That's a very good price. There was an asset traded 2 weeks after that for $70,000 flowing, and 2 weeks before there were a couple of assets went in the 65. So we think we got a great deal. These assets, you can double production, and that's the way we like. That's one of our screening criteria, double production and superior rates of return. They take our corporate netbacks, increased by 19%, and our corporate decline decreased by 6%. And we got 67 locations in inventory. This is the first one of those. It's a Redwater Viking asset just northeast of Edmonton. Adds on to our existing base. Our existing base was in yellow when we bought Husky out of here in the blue. You can see the nice integration of assets here. This one has been fantastic. The PDP production is up 48% based on small optimization work. It's going in after someone who really hasn't focused on the asset. We went in, we spent 15 to 18,000 per well on 11 wells, and we boosted the production 200 barrels a day on the oil side, 415 BOEs a day on the gas. And you know what? That's stuff that we never even thought we would encounter. We didn't build that into our acquisition forecast. That's all gravy. And we just completed 2 wells there you see in black there in the center, and we'll be boosting production further on that. This is the Penny asset down by Lethbridge. 72 million barrels in place. Only 10% of the oil has been recovered. It's an immature water flood. All the heavy lifting in terms of capital has been put in terms of batteries, gas plants, and water injection facilities. And we're taking this asset, drilling 17.5-mile wells, and we think we'll be able to take that production or the recovery from 10% to 23% with the implementation of those horizontal wells. Up or down to the lower right, we're just drilling our first well. We're just around the bend right now, around the corner, and that well will be 1.5 miles. As I mentioned, we can take 1,000 barrels a day of oil production here, make it 2,000 barrels a day up to the end of next year, provided we've got all these wells in our capital plan. I mentioned a bit about costs. You can see superior performance on cuts, 27% down. On a per stage basis, which is really, every frac that you do, that's what you're really driving to. What's the cost per frac? And that we've gone from $145 per stage per frac in 2014, and we've driven that down to $52,000 now. So technology on all these resource plays has gone it's just improved so much with the time that we've had in low oil prices to relook at our designs. We're going to be making as much money at $60 as we did at $100 with the technology and the way that's ramped up. Operating costs, nice cuts there, and then the G&A. You might hear E&P companies talk about half-cycle rates of return. I talked about payback. The bulk of our program is going to be drilled by a combination of Wilson Creek wells, Penny Barons wells, and Alder Flats wells. And you can see rates of return on all those blended. All of them get in that 1.5 year or less. In fact, the Wilson Creek are 6-month paybacks on those wells. They get about a blended 85% rate of return half cycle. By the time you burden all the costs in your company into those programs, you get what an investor would look like as a full cycle rate of return. And with the capital program we've got second half this year, we have a 35% full cycle rate of return. And my internal target for the guys this year was 30%, so they're well on their way. When you have superior well results like that, you can do the following. You can build cash flow per share growth, and this suggests we're in that 44% over 2 years, 20% combined. You can build inventory, especially at these prices, because land is cheap now. And you can drive down debt, and that's how we've driven our debt to cash flow down below 1. So superior well results gives superior corporate performance. Just we haven't put guidance out next year, but just to give you a snapshot of what our production could look like, we can drive cash flow per share, or if we spend about $62 to $65 million at $45 WTI, we're going to be holding production flat. We hit $50 WTI like we are today, we're going to be growing cash flow per share 15 to 18%. 75 million will be our budget, and we'll grow production to 12,000. If we get another $5, $55 WTI, we'll be growing cash flow per share 30%, spending 95 to 100 million, and we'll get production up to 13,000. And if you look at the bottom, that is with very conservative pricing. We're only using $2.65 a GJ for AECO gas, and a lot of my competitors using $3.50. So in summary, I think we've demonstrated very good discipline in this downturn. We've focused on costs. We focused on improving our well inventory, and that enabled us to pay down debt, yet deliver modest production per share growth. We've had a top quality inventory in 2015. Just today, National Bank wrote us up as having the top 2 Cardium wells out of 15 in our well results. Last year we got 3 of the top 15 in oil wells in Alberta. And then 2017 we'll be growing production and continue doing tuck-ins. Thank you very much.